Welcome back. Now at the full-year mark, weak chemical prices and impairments are weighing on Sasol. As a result, the petrochemicals giant has suffered a 66% plunge in headline earnings per share. And considering the group's net debt position, no final dividend has been declared. Company CEO Simon Baloyi joins us for a closer look at the performance. So Simon, thank you for your time and good afternoon.
Afternoon, Nolutando. Thank you for inviting me.
All right, maybe I'm keen to start off by understanding just your sentiment around this set of numbers. Of course, when we quote the numbers, it does look like quite a big of a plunge, and we'll get into the meat now. But overall, how are you feeling about the performance that Sasol has put out at this time?
Yeah, no, thank you, Nolutando. I mean, looking at the global macros that we faced in terms of the weaker Rand oil price. We saw the oil price dropping by 3%. The continued weak demand in the chemicals, which is affecting both our chemicals Africa and international chemical sector. We've seen prices dropping there. You saw the polyethylene price drop by 10%, but the gross margin on the chemicals Africa, is as high as a 31% drop. So there's serious concerns about pricing. So those are the macros that we faced. But notwithstanding that, I'm actually pleased because if I look at the volumes, in all the segments, year on year, we grew on volumes. You saw as we released our results, on the Secunda operation, we had a 1% volume uplift in Mozambique, more than 6% in terms of gas flow from gas production and from Mozambique, and chemicals Africa, and also international chemicals between 2 and 3% volume growth. And finally, mining at 3% volume growth. So that shows you in terms of responding that our teams year on year have actually surpassed or maybe met the market guidance in most segments that we gave. And looking at the cost, cash fixed cost, you saw it's almost flat. So if you then take into account inflation, we're actually 5% down on cost. So we focus on the controllables. So that makes me, very pleased to see the team not only looking at the macros, but controlling what we can control. So that went okay. So if you look at the EBITDA, notwithstanding a very, very tough market, our EBITDA was only 9% down. This talks to the ability of our two businesses to cushion each other because the energy business did come to the party, even though those businesses are not at full potential, which I've indicated it is going to be my short-term focus to make sure businesses go to full potential because we're leaving money on the ground. So we have to make sure that we go to full potential. But we do cushion the weak chemical performance by having those businesses, almost hedging one another. So I'm relatively pleased. But of course, the non-cost item, the impairment in the US, that you did mention it. Of course, that weighs heavily on our performance because once you adjust for it, we're showing an operating loss.
Let's speak about the impairments and maybe even the circumstances that led to the decision for these steep write-downs, Simon.
Yeah, coming back to the impairments, I'll first start by saying we have a fantastic asset, in the US. We built a world-scale cracker, a 1.5 million ton cracker, which is running and operable. It gives us lots of cost efficiencies. We've got fantastic downstream units because not only do we produce ethylene, we have the ability to produce polyethylene and other derivatives in terms of the alcohols and surfactants. So it's a great asset. So what happened to us is that the assumptions, and this is not just our own assumptions, but it's the long-term pricing outlook. And this is the delta between ethane and ethylene. So we saw that gross margin coming down. And because of that, we had to impair the assets. So we impaired it purely based on the longer-term pricing assumptions because we didn't see the prices coming back, quite soon. However, I must state that, this is just purely based on the assumptions. We're not just looking at this problem and doing nothing. Already in April, we started making sure we reset those businesses. And that's going. That's a process that's going ahead. We're going to give the market a full update in terms of our reset, in terms of the international space. And what we do there, we firstly are going to focus on streamlining those businesses. That will give us a cash fixed cost advantage, where we start reducing the cash fixed cost in those businesses. We're going to do a full assessment of all our plants and value chains so that we can take radical decisions on non-performing assets that we have in our stable. We will deal with those. And finally, we're going to look at our go-to-market. So those three buckets vaguely will come with definitive targets that the market can start tracking us on.
Let's talk about in the balance sheet here. We are seeing debt of just over $4 billion. I think it's around 78 billion rand or so. That has led to you not declaring a dividend. But I want to speak about, ideally, where does that debt amount sit for you, Simon? And maybe even then working our way back to a balance sheet that can support some of the initiatives that you plan to bring forward.
Yeah, thank you. Looking firstly at the ratios, if you look at our net debt to EBITDA, below 1.5, that's not bad. But what we did, we realized, you remember we changed the dividend policy. Our dividend policy in the previous years was always in terms of headline earnings, and you use a cover ratio to pay a dividend. What we did last year, that now allows us to pay dividends out of debt. So we actually want to start driving our debt down. And the consequence of that is that year on year, our debt almost didn't change. We were like 3.8, we went up, and we're still at around the $4 billion mark. So our focus now is to have a dividend policy, which is based on paying dividends when you have free cash flow from your operating activities. We've changed that. We will be able to pay 30% of that cash back to shareholders. So our intention is to make sure we create value and continue paying dividends. But we've set the $4 billion mark because we said we want to start going down from there. So for me, if you are sustainably below the $4 billion mark in a sustainable manner, if I look at our EBITDA, I think we'll be okay in terms of the covenants to allow us to embark on our growth initiatives.
Well, that's it, Simon. I'm also then keen to find out about, now that we've seen the write-downs and they've been quite steep, and as you're saying, it's all based on assumptions, which means that you're consistently, scanning the environment, ensuring that you are, making those assumptions based on the most accurate information you have possible. Can we say that the big impairments have gone through the financials now, and when we look ahead, we do expect, the business to have less non-cash items weighing heavily and more of the operational efficiencies coming through?
Yeah, thank you, Notanda. Spot on. Going ahead, we expect the businesses to, at least most of these are now behind us. Most of these are behind us because this was a big write-off if you look at the US asset. But you remember the impairment as well. It's always about the carrying value of the asset and the value in use. And based on today's assumptions, that's what we saw, and we decided to write down that asset. However, management, we're taking actions, and we're not just watching this and looking at it and accepting it. We're taking actions to make sure that our assets performance, firstly, we'll want to go to mid-tier and ultimately go to top tier. And we believe that those assets, our international assets, are valuable assets and will be able to generate value for the group.
Well, Simon, I look forward to chats in future to unpack some of those plans. Thank you for your time this afternoon. Have a great day further. That was Sasol CEO Simon Baloyi.